Please take a minute and put your answer into the poll that we have so we know who is in the room today. Welcome. Thank you for joining us. My name is Jamie Schenker-Passero. I am the Director of Programs for the Temple Small Business Development Center. I think I'll go and share the results. All right, so it looks like we have a good mix of folks here today. Some not knowing their credit score, some with a credit score over 650, but most people know their credit score and it's under 650. So did I share that? There we go. So you're in the right place. We are here to talk about credit today. If you are not familiar with the Temple Small Business Development Center, if this is your first time joining us, we provide no-cost business support to small business owners throughout Philadelphia, Lower Bucks, and Eastern Montgomery County. We do this with one-on-one consulting, as well as with our training programs, like the one you are joining for today. This is part of our Startup Essentials series. We offer monthly, quarterly offerings for businesses who are pre-venture or starting up and need to get those business foundations. So today we are joined by two team members from Truist Bank. We have Scenaria Henderson, who is Senior Community Bank Market Leader and Vice President. Is that still an accurate title? I looked it up.
Close, branch leader.
I couldn't find his signature. And we have Luke Chassard. I didn't ask you how to pronounce your last name. I should have done that. But he's a business banker at Truist. And we're going to go through a presentation today, a little bit under an hour, about the basics of credit and a bit on credit repair. And I know this is a really important topic for all small business owners. We are going to ask that questions be addressed in the Q&A. That's the most efficient way for us to get the questions answered. So please put them there. If it makes sense to address them during the presentation, we will. Otherwise, we'll get to them towards the end. So thank you, Scenaria and Luke, for presenting to our entrepreneurs today. And I will let you take it from here.
Great, I really appreciate that, Jamie. Thank you, and thank you to the SBDC for having us. As stated, we're teammates of Truist Bank. Scenaria and myself work together extensively. I work most specifically with businesses, but do get involved to a large degree on the personal side, business owners and aspiring business owners. Scenaria in her own right does much of the similar stuff that I do. She has a branch and actively works with a lot of basic, retail and individual needs, but to a large degree does a lot of things with businesses as well. Anything from loans and deposits to beyond. And our information currently is on the screen right there as just a disclaimer to all what looks like 28 of you. Thank you so much for joining. Please take our contact information down and, don't hesitate during this presentation to ask your questions. But both Scenaria and myself want to serve as a resource to you. So take the contact information down and even after this presentation or in another day, month or year from now, if you ever want to reach out and have a conversation about where you're at in your entrepreneurial process, please use us as a resource. So we wanted to reiterate that. On our next slide here, we have a bit of an elaboration as to the institution we work for, Truist. Truist is ultimately here to serve its purpose. That is, as you can see on the top line of the screen, to inspire, build better lives and communities. Now, there's many ways that on a daily basis, even that Scenaria and I have the opportunity to live out that purpose and mission. But today provides a really pertinent opportunity to speak to you all. As stated, our job roles integrally relate to working with young businesses and even individuals who are aspiring to start a business, even long-standing and mature businesses. So, we do this on a regular basis, but Jamie and her organization has provided a really efficient way for within the next hour or so to speak to all of you simultaneously. So we've been really looking forward to this opportunity because it does greatly correlate with what we're trying to do and what our bank is trying to do on a consistent basis. And largely, business owners are the backbone of our communities. So if we can try our best to help you guys and be successful, hopefully in more instances than not, then you all are really going to constitute the community as a whole and be the ones that are truly changing the community. So thank you for serving as a medium in which we can change our communities through being a resource to you all. But on the next slide, we'll see a bit of an intro to what Jamie stated as our focus of the next hour, really a foundational piece to achieving what we think a lot of you on the webinar here are looking to do. It's a foundational piece to the business that Scenaria and myself do, and that's credit and credit reporting. Credit reporting refers specifically to each individual out there in this country with a social security number to businesses themselves, and then contextualized in that those businesses are made up of individuals with their own credit reports too. But we're ultimately gonna discuss various strategies as it relates to building and repairing your credit, and really provide some insight as to why that's important in your entrepreneurial endeavors as your business develops and grows, and then hopefully is prosperous over time. And on the next slide, we'll begin to get into the nitty-gritty of that. Starting fundamentally, credit score itself is really a 3-digit number, perceivably, but is ultimately a lot more than that. That number summarizes a snapshot really in time of everything kind of lifetime to date, career to date, that an individual has done as it relates to their credit. Credit scores can range, individual credit scores, personal credit scores can range from 300 to 850. Typical mean, a typical average is about 650, 670. There's a lot of nuances to this following statement, but as a general kind of universal rule, those scores north of 670 are considered better scores than those below 670. And there's really, and we'll progress to talk about this further, but there's almost a percent breakdown of certain categories and certain elements of a credit score that ultimately adds up to this single number. But like I said, it's your credit score really begins becoming what it is early in your life, and then kind of follows you throughout time. And the reason why we want to really phrase this entire presentation as an effort to be strategic is because considering credit score was with us 10 years ago and will be with us in 10 years, there's a lot we can do, each one of us right now, to better our credit score and continue to get it in a position that is going to allow us to have more financial liberty in the future. So, I can speak on behalf of Scenaria and myself kind of to the importance of a credit score, in that really the first thing that we do when someone walks in our bank, and this is why the credit score is there, we consult the main 3 credit bureaus, and kind of cross-tabulate, what's your score at each, what the individual score is at each one. Those 3 bureaus are Experian, Equifax, and TransUnion. And, since we really, have very little perspective on what a prospective customer brings to the table in terms of their credit history, this score is ultimately the finest tool we have to kind of provide that picture. And creditors and lenders, take your overall credit score into an account, really when beginning the conversation as to whether lending to an individual is feasible or not. And as stated, this happens on the individual level, but also on the, on the business level as well. If a certain LLC or partnership, walks in the door, me and Scenario are going to be asking, hey, who are all the owners and what are their individual credit scores? Not just the credit score of even the business as a whole, but those individuals that are constituting and supporting the business. So
Hey, Lou,
we're going to kind of,
Luke,
yes.
I have a question that might fit
Yeah.
in well now, so I'm gonna see if you can answer it. In terms of the three
Please.
credit bureaus and the different scores, if there are different scores, which one would you look at? How would you handle that situation?
Yeah, so great question, Jamie. Thank you for stepping in to ask it. So each bank, really, kind of is inclined to look at maybe one or the other, or at least a, a consolidated kind of average of the three. Really, we most typically look at Experian. Other banks may be inclined to look at Equifax or TransUnion instead. But each bank, given the complexity of, a credit request, a given bank may pool all three if it really wants to get into the nitty-gritty details. Now, ideally, and we'll talk about this later in the presentation, you want your credit reports to all be accurate. And if they're all accurate, they're all going to look the same. And it really is not going to matter, which bureau an institution accesses for that information. Like I said, we'll get into, how to do that. But ultimately, if each report is accurate and its details within, they're all going to reflect a very similar score. And then ultimately, one report will look the same as another, and your average is just going to be a reflection of each one consistently. The next slide, I really, hit on this already. It does ask why our credit score is important. It is the foundational piece that any lender is going to first, look at. And we don't have, much of an insight, especially as it relates to new customers, coming off the street. Besides, financial information that you provide us that may, provide a snapshot in time of the here and now, or how much your income was, say, in a specific year. The credit report really summarizes everything and is a resume that consolidates all the relevant and important information into a single report. What really constitutes that report is outlined on our next slide, and I did allude to a pie chart. We'll go around the wheel here, but as stated, your three-digit score, in summary, represents the ability that an individual has to pay a debt, and a debt over a course of time. There are, for simplicity's sake, really 5 elements that constitute any credit score. There are certain weights associated with each element. You can see that listed here. You have payment history before you. 35% of your 3-digit number in a given credit report really contributes to that score. 30% summarized in amount owed, types of credit, 10%, new credit, another 10%, and length of your credit history ultimately constitutes about 15% of your score. And really, this is formulaic. So, you know, the payment history piece, which is what we'll address first, because it is, you know, the largest piece of the pie here, you know, really accounts for every single loan, debt, credit card, anything that's been reported to the bureaus in the past. What is your track record of paying? There's a few variations of how payments are viewed. They're viewed as on time, they're viewed as late, and they're viewed as never paid at all. Obviously, you're going to want each item in your payment history to reflect on-time payments. You know, a few late or delayed here and there can be contextualized and nuanced, and there can be a perspective applied to that. But an obvious red flag is you've had debts before that have never gotten paid. And then looking at those three potential outcomes over the course of your, you know, decades-long history of being an adult in this world, if you will, you know, the Bureau really can start to reflect through your report a pattern of how well of a payer of your debts you are. The here and the now is particularly important. 30% refers to the amount owed now. We call this exposure at the bank. You know, if someone has a finite amount of resources, which we all do, you know, only a certain amount saved, it only makes a certain amount a year. If they have this expense, and this debt, and this debt, and this debt, and, you know, add in progressively more debt onto a borrower, you start to threaten their ability to pay back that debt or any of the debt, because that debt outpaces how many resources, how much resource, and how much income that borrower has. So 30% considers, you know, if we apply this new debt to a borrower and belabor them with this new debt, you know, what other debts are they also going to have to be paying simultaneously? 10% considers the credits used. There's multiple arrays of banking products in the forms of loans that you know, borrowers may be utilizing. Anything from a credit card that needs to be paid back regularly on a schedule, to a long-standing mortgage that also needs to be paid back regularly, but is a fixed amount, not variable over the course of decades. You have lines of credits which potentially be used, but maybe not. And when they are, it's only interest only, and they're not, borrower may not be obliged to pay back everything that's owed at a given time. So how much, you know, besides looking at just the items of debt, what type of debt and what burdens do they apply to the borrower at what point in time is very important. New credit refers to recent activity. We can look to see on a credit report if not only has a person been walking in our bank asking for a new credit card, but have they done this to 20 banks in the last month? That could be a red flag, because there's an indication there that, well, they get approved for all those credit cards. What's the chances that all of that is, you know, all of that's, you know, able to be paid back in a timely manner? And length of credit history is really summarizes how we want to see all this information, you know, over a course of time, so we can detect patterns and really attribute a credit identity to an individual over decades. You know, having one loan that's a new loan to you, you know, as of 5 months ago, and you've made 5 on-time payments is great. You know, that's something that's very commendable. But what's to say that the 6th or 7th payment won't go awry or won't go missed? A bank's going to feel much better about seeing that, okay, for years this person has exhibits a pattern of behavior that shows that they keep their credit, up to date and tidy and pay on time. It's just a simple principle of data. The longer and deeper it goes, the more reassuring it is to the people looking at it. The next page, we actually see how those pieces of this pie chart really break out into the sections of a credit report. Now, this is just a sample of Experian, which is what we use at the bank, but you can see it's relatively self-explanatory. At the top of the page, you look at, your basic information is listed, and I'll get onto this a bit on the next slide, but, personal profile is really important. This is the information that can be used really to identify you. If you have a common name, John Smith, my name is Luc Chassard. Chassard is a little more popular in, say, France than the United States, but there's still 3 Luc Chassards out there in the United States. I want to make sure that when I go and apply for a bank card at Truist Bank, that they're judging me by my history and not Luc Chassard that lives in Wyoming. Nothing against that Luc Chassard, but there has been multiple instances, believe it or not, where our quality control teams have had to fact check reports and say, oh, nope, you have the wrong John Smith, or whatever hypothetical example I provide. We're actually looking for the one that lives in Philadelphia and not Lancaster, for example. So anytime you do review your information, please make sure your social security number, your address, all your pertinent information matches. The next page of the credit report sample we were just looking at, the next section is a credit summary. Credit summary really takes all the subsequent information and breaks it out in an abbreviated form. See how ultimately the credit report got to the 3-digit total score number that it did. You're going to see listed here really all the accounts you've ever had, any type of summary of public records, which includes bankruptcies, tax liens, judgments. A lot of generally bad things appear under the public records section. Any type of credit inquiries, the number of inquiries, and account history, or just general score per card, per loan, per auto loan, in terms of like how you've been actively paying each one of those items over time. The 3 subsequent pieces of each credit report then breaks out that summarized information. As stated, the public records section is generally the red flag area. It's going to show, anything to the state or federal government that appears as a flag. Typically, that's them saying, oh, this individual was late on paying their taxes, or, oh, this individual filed bankruptcy with the government in 2014, et cetera, and so forth. Credit inquiries is a very important piece to mention. It refers to really any time an institution, third-party institution, someone other than yourself has access to your credit report. If you remember, a portion of our pie chart that was particularly important was the new credit section, referring to, okay, in recent time, how much loans has this person been taking out? What have they been doing recently? Is there a worrisome pattern being exemplified that shows that, oh, they are going to every bank in town trying to get a credit card, not just us, and what happens if all those requests get fulfilled? Credit inquiries really summarizes, okay, when has the credit report been used and why and by who? Account history is going to be the most detailed section of the report. When a bank and a banker,
Hey, Lou, before we
like
get
myself
to that
in there,
section,
yeah.
Do you mind if we just go back to the credit poll, because 2 questions came up?
Great.
Okay, so one of them is, why does checking your credit score hurt your credit one would think that if you're trying to stay on top of your credit, checking it periodically would be a good thing. And aren't there ways to kind of do that without negatively impacting your credit?
There are. Now, the inquiry I was referring to, and thank you for the question, refers to when a third-party institution pulls your credit. And it's really marginal, the degree that it hurts your report. You know, if your score is at 800, it may bring it down to 795. It's relatively a small hit, but by virtue, and this is why you need to be careful in authorizing which institutions pull your credit, and make sure you have an understanding of what institutions are doing that when, and they really, of course, you know, need your explicit permission per regulations to do so. So it'll be clear when they request your authorization to do so. But you giving an institution the authorization to do that is explicitly interpreted as, okay, this person is, you know, looking for more debts, and more debts piled on. I'm kind of simplifying the logic here. More debt piled on means that there's a lesser chance that someone could repay an additional debt, an additional hypothetical debt in the future. It kind of correlates with just the amount owed in total that, you know, was previously discussed as something that, you know, constitutes a credit score to a large degree. There are resources, and we will get into it, where you can, you know, check on your credit, which we're actively going to encourage you to do separately, just to check for any type of inaccuracies and, you know, track your progress and your score, and see how your behaviors affect your score, et cetera, and so forth. There are many services, and Truist does help to provide them. Like I said, we'll get into that information, where you can actively, you know, you can actively do that, and it's not going to hurt your inquiry tally. You say there was a second question, Jamie?
Yeah.
Before we move on to that question, I just wanted to add in that additionally, I think it's important to understand the difference between a soft inquiry and a hard inquiry. So if you hear the terminology, a soft inquiry, you may get letters from Capital One and saying you're pre-approved, congratulations, you've been pre-selected. Typically, those are soft inquiries pulled. So they're taking a soft, they're looking at briefly at your credit worthiness when they do a soft inquiry, which means that does not impact your total inquiries. When you hear the term hard inquiries, that's where you want to, if you're concerned about inquiries, that's where you want to be concerned, because those are the inquiries that do in fact impact your credit. So I think when we're thinking about inquiries, you know, we need to understand the difference between soft. When you go and open up a banking account, most banks run a credit report, but it's a soft inquiry. So that doesn't impact your score. So you won't see that on your credit report. You will in fact know that it's a hard inquiry when you see it on the credit report under the inquiry sections. And Luke is going to continue to dive into that.
So we will cover like the top few hard pulls, like what we consider the top few. I think that might help people. If we're going to get to that, if that's okay, then that's great. If not, it could be great to cover that. And then relatedly, someone asked, is there ever a situation where one can apply for business credit with an EIN without using a personal hard inquiry? Luke, you are muted.
I'm sorry, I'll jump in there for him. So for the most part, when you think about business credit, so essentially the business, you want your business to have credit. So you're applying for a business line, a business loan under the business credit. But the way that most lenders look at it is that, okay, so the business is an entity in itself, but then in the event that the business, there's an issue with the business, they need to go after another entity to collect the debt. And so that would be where a guarantor comes in, a personal guarantor. So the reason that most banks pull the individual's credit is because we need a guarantor on the loan. We need someone that says, okay, I am guaranteeing under my social and my credit that should something happen with this business and the business does not have the ability to pay, that I will be responsible for that debt and guarantee that debt. So hopefully that answered the question.
And really, it's largely contextual. I mean, we see in instances where, say, a sole proprietorship, which is really just one owner who constitutes 100% of the ownership of a company, largely, you know, that individual's finances are more intrinsically tied to that company's finances than, say, a company with 6 different owners. In instances where there may be a minority owner, individual with a minority stake, which typically is about 20% or less in a company, you know, banks will be less inclined to really even consider that individual in the underwriting process. And often, you know, that individual will not be, you know, have a inquiry run on them. But in a lot of cases, you know, if someone has a 0.25% ownership, for example, 25% or more, it's very conventional to expect that that person will have, you know, to provide a guarantee like scenario was, you know, saying, in which case we'll have to underwrite and pull the credit of that individual themselves. So.
Okay, I think there's this little confusion about why it negatively impacts the credit score. I think maybe this is like a philosophical question, and I get the frustration, right? If you're just trying to check in, or a lender is trying to, you know, give you capital, why that would hurt your credit score. So I think this is more of like a societal philosophical question. And if you have any answers, you know, Truist didn't invent this, so we're not going to blame them for it. But if you have insight into the why, that might be a helpful frame of reference for some of our attendees.
Yeah, absolutely. So go ahead, Scenario.
I'm sorry. So in some cases, there are individuals that shop for credit. So for example, let's think about when you're buying a car, when you're purchasing a vehicle, you're not going to go, you may go to the dealer, you may go to your bank, you may have a credit union. You're trying to shop for the best rate. That is completely understandable. We understand that. So that is a different type of, you know, those are going to show different types of inquiries. Now, in some cases, some people are looking for loans. They get declined from one company, they go to another. They get declined from another company, they'll go to another. So the way that the credit bureau is viewing this is in a negative basis, because if you got approved, then you would have no need for additional inquiries. But it says something when that creditor is not approving you and you're continuously looking and looking for someone to approve you. It could also say a lot to what Luke was, to Luke's point, it says a lot about, and I'll cover this a little bit, the 5 C's of credit, kind of your capacity. Do you have the capacity to repay this? So it's more of a risk type of situation when the credit bureaus kind of ding you for the inquiry. I mean, I personally don't agree with it as well, but with that being said, in a lot of cases, it's based on, you know, is this person just shopping for credit, or is this person actually not getting approved from these lenders, from these specific companies, and they're trying continuously, and why are these companies not approving these loans?
So the idea is kind of like, if it was just one bank one time, it's not going to make an impact, but the impact really comes when you do this behavior that's trying to be dissuaded of shopping around. So
correct. And just one other thing to note is that when you are in fact shopping for credit, so let's say, for example, you're trying to get pre-approved for a house, you're buying a home, you may check Truist, you may check Wells, a couple of other banks. If you're doing it in a certain time span, that does not impact that doesn't negatively impact your score, as long as it is the same type of credit you're applying for. So if you're trying to get pre-approved for a mortgage, I mean, we understand that people want to look and shop around and see what the best deal is that they can get. That's same way when you're buying a car. You're not going to go on a date with the first person that you talk to. You're going to weigh your options and see what is the best deal that I can in fact get. So that is understandable if you're doing that in a certain time frame. But then when you have situations where you're applying for a mortgage, then 2 weeks later you're applying for credit card, then you try another credit card, and then you're applying back for a loan. It's kind of all over the place. That's a red flag to the credit bureau. So you just want to be careful when it comes to that.
Thank you. All right, we can get back to the slides, and then we'll save some other questions for later. Thank you.
Great, thanks. And the final piece I was going to cover is just on the right side there, account history. The most detailed part of the report really goes item by item, debt by debt, everything from your past, and shows, you know, what type of, you know, loan it was, what from what institution, when was it originated, is it still active or not. There's a summarized payment history as well, indicating whether you were on time, late, or never paid. All these details can get quite meticulous. And as a best practice, when you do utilize a soft inquiry service to review your credit reports, this is the section that you really want to check for accuracy. And in many of cases, you know, when Truist pulls, you know, let's say an Experian report, you know, we'll focus on the details, you know, kind of baked into this section of the report. And if there's something we see we have a question about, oftentimes we'll ask a customer or a prospective customer about it, and they'll say, huh, you know, I did pay off that loan. I don't know why it's still showing as active. Or, oh, you know, no, my April payment wasn't past due. I even have, you know, a receipt to prove that. And all these details are really reconcilable. I mean, TransUnion, Experian, Equifax, they all get contacted by consumers all the time saying, hey, there's an inaccuracy on my report, and I would like to change it. And it's always a good practice to proactively engage that process, so that at the instance you want to go to a bank for a loan, you know that what they're first going to be looking at, your credit report, is an accurate reflection of your history. Transitioning into the next slide, I believe Scenario is going to continue from here forward.
Thanks, Luke. Okay, so let me just start by saying thank you, first of all, to Jamie and Temple University Small Business Development Center. I am so excited to see the amount of conversation around credit. I'm looking in the chat, and there's a lot of questions and a lot of excitement around it, as it should be. Regardless of whether you're an entrepreneur, you know, if you're not starting a business, if you're in the business, regardless of what stage of the business cycle you're in, credit is important. So we'll start by ways to establish and reestablish credit. So to establish credit, there are several different ways you can establish credit. So think about applying for a loan, opening up a credit card, opening an account with a co-signer. And when we think about loans and credit cards, you know, I think I saw something in the chat where someone was asking about getting approved for a loan. We want to think of secure cards, secured loans, because let's think about it. If you don't have credit, then the chances of a creditor approving you first time may be minimal. If you don't have a credit score, how do you get that score? And there's ways that you can establish those through secured loans, secure credit cards. To rebuild a credit. So I also saw someone in the chat that was mentioning something about a nasty divorce. So that sounds like that person's in the rebuild stage of credit. So number one, you want to get a copy of your credit report, because if you don't have the credit report, how do you know what to fix? How do you know what's reporting that you're not aware of? There is a service, and we'll make sure to put this in the chat, annualcreditreport.com is a great feature to see, a great way to get a copy of your credit report. Some people subscribe to Credit Karma, and then some banks offer resources where you can actually see your credit report. But knowing what's on your credit, knowing what your score is very important, especially, you know, if you're trying to rebuild credit. Applying for a loan or credit card with a cosigner, open checking and savings accounts. So, you know, starting with a bank relationship, checking and savings is the start of the relationship. But to rebuild credit, you want to make sure that you have a relationship with an institution so that you can later down the line, depending on your checking and savings relationship, apply for credit cards, apply for loans. And then open a secured loan or credit card, which is what I talked about. That could also be a resource when you're rebuilding credit. To maintain your credit report, don't. Credit repair companies. So as tempting as it may be for an organization to say, we can wipe your credits clean and give you an 800 credit score in 30 days, don't. Credit repair companies, for the most part, a lot of credit repair companies will dispute, and you're really not getting anything out of it. We have resources, and we can provide that at the end of this presentation, where we can sit down, take a look at the credit report. We have resources in the organization that we work with to specifically help you actually repair your credit. Miss or ignore payments. So that's something that you don't want to do. Luke covered the pie chart that explained the percentages of credit and how it's built. Credit history is everything. Credit history, as you notice, that was one of the biggest parts of that pie chart. And that is because you will not receive credit. You can't get additional credit if you're not making your payments. So making sure that you don't miss payments, that you don't ignore payments, if you can call, and even if you're making just the minimum payment, you want to make sure that payments is something that you're keeping close, top of mind. Closing existing credit accounts. This is something that I can't reiterate how important it is not to close an existing credit card. So it is one thing if you use, I'll use myself, for example, Old Navy credit card that I had for many years. I don't shop at Old Navy, never used a credit card. They closed the credit card account. That is absolutely fine. It's another thing for me to then in turn contact Old Navy and say, hey, I no longer want to use your credit card. So closing existing credit accounts, you want to make sure, even if you're not using the credit card, even if you dislike the company, allow it to report on the credit report and then allow the creditor to close it. There's a difference between when your credit report is closed due to credit guarantor closing and versus whether it's closed due to you closing that account. Next slide, please. So tips for using credit responsibly. So no matter where you are, if you're establishing credit, if you're reestablishing credit, we need to be responsible. Otherwise, you won't continue to get credit. So keeping track of your credit lines, you want to make sure that you know what you have. You know, I deal with several clients that have 20 plus credit cards. But you should understand, you should know what your credit cards are, what your lines are, what your limits are, using a budget. So if you have an extensive amount of credit, you want to make sure that you're on a budget because, again, that goes back to repayment. We want to make sure that you have the capacity to repay that back. Saving for larger purchases instead of using credit. So when you're purchasing a house, when you're a first-time home buyer, the first thing that most loan officers will ask you to do is to not get new credit. So saving, making sure that you have a savings account in place, and a way to save is going to be the way to go for that. And then review your credit report annually so you know exactly what's on it. I'll take that a step further and say review it more than annually. If you can review it quarterly, if you can review it a few times a year, that's going to help you understand what's on your credit. Oftentimes, I have been in conversations with clients, both business and personal. We've run the credit. I've asked them about, hey, what is this item on your credit report? And they have no idea. So that is why it's very, very important that you're reviewing your credit. Again, there's a resource, creditreport.com, where you can get a free copy of your credit report. There are other resources like Credit Karma, where you could take a look just to see what trade lines, not necessarily for the credit score, but you want to look to see what is on your credit report. So if you had a collection pop up, then you would identify that at that time if you're staying on top of reviewing that. Next slide.
Hey, Scenario, do you get a credit ding for not using a credit card?
No.
Okay. Thank you.
No. So you mean if you have a credit card and you never used it?
Well, either that, or I think kind of like the scenario that you were talking about where you're just no longer using it. I think someone wrote about it, but I don't think that's the case that you get a ding for not using. Yeah, I don't.
No.
Yeah, Missy, I don't think there's a ding for that.
No. You will get a ding for using it excessively, or and we didn't talk a lot about this, but so utilization is everything when it comes to revolving credit. So whether that's a home equity line, a line of credit, a credit card, those are all considered revolving lines. So when you look on the credit report, you'll see a section that says revolving. That's what's meant by revolving, because you can constantly use that debt. You're given a certain amount, you can pay it down, use it again, pay it back and use it again. What's important that you need to maintain, that you need to realize, is that you want to keep that under 30%. So just because you're given $1,000, you don't want to use $1,000 of that credit line. You want to try to make sure that you're using as minimal as possible, and you want to try to keep that down to 30%. When you do max your line, that does impact your credit score. That does negatively impact, whether you're paying it on time or not. If the credit card is max or close to max, then it does show it, that does impact the credit score. I just wanted to cover that before we went into controlling your debt. So again, around controlling your debt, make a list of all your debts. So making sure that you know what you owe, even if it's something that's not reported. So for example, if you have AT&T, Verizon, or credit card bills, they don't report to the credit bureau. So it's important to know that is a debt. That's something that you have to pay monthly, because when you're doing a budget, you want to make sure that you're aware of what you actually pay. You want to rank them from smallest to largest. So looking at the smaller items that you pay on a monthly basis to the larger items. Get ahead by making more than the minimum monthly payment. So you have a credit card that's $500. Your minimum payment is $10. The creditor is going to charge you the minimal, they're going to give you the minimal payment possible, because they want you to keep paying. Why? Because each month you're accruing interest, and that is how the company is getting paid. So you have a credit card balance of $500, your minimum payment is $10. You want to pay $50, pay 50, 50, 50 until you pay it down. So this way, not only are you tapping into, covering that minimum payment, but you're covering the principal portion of that as well. And you're paying that down a little faster. Once you get out of debt, try not to get back into it. And what is meant by that is that if you've maxed out your credit cards, all of your credit cards are maxed out, you pay it off, let's say you receive a bonus, a tax return, you have the ability to pay that stuff off. Please don't go back to Saks and charge the stuff back out. You want to be smart when it comes to credit and stick within that 30% utilization. So if you do in fact have to use the credit card, then you want to make sure that you're paying back more than that monthly payment and keeping that credit card utilization amount down to below 30%, so that you can in fact still maintain a good credit score. Next slide. Again, with controlling your debt. So in this example, we start with a $1,500 credit card balance and try to pay more than the minimum due each month until it's gone. So again, same scenario that I gave before. Credit card is $1,500. Your minimum payment may be $25 on $1,500. You want to try to pay more, maybe pay 100, but you want to get that down. Another thing, another miss that many consumers miss is that when you have 0% interest rate cards, so if you get a promo offer, which Truist offers credit cards with 0% interest as a promo rate, when you get that, that is the time to take advantage of buying an item. You're not paying any interest on it. But keep in mind, you want to pay that back. So during the introductory phase, that is the time to maybe transfer a balance over to that credit card because you can quickly pay it off because you don't have to worry about interest. That's the time to make a purchase because that's essentially helping the credit. As long as, again, you're looking at the utilization and then you're making more than your monthly payment. Next slide. Benefits of paying down your debt. So to me, the biggest benefit is to be debt-free. But in addition, increase financial security. So, you know, you can live stress-free when you don't have the burden of having a whole bunch of debt, life enjoyment, improved credit score. So by keeping your credit card debt down and your other debt down, that's actually, in fact, helping the credit score. You'll see that when you have very low balances, that is the time when you see that score jump. You'll see it jump 10, 20 points, depending, again, on the utilization and the lower it is. So if anyone has Credit Karma has a very cool feature. As soon as you make a payment to something, within a couple of weeks, they'll give you an update. Hey, your credit score is, you know, your credit score jumped 10 points as a result of paying this. Your credit score dropped as a result of not paying that. So that's a great way to improve your credit score by paying down debt. And then own assets, finally. You know, you can't, if you have a whole bunch of debt, it's very difficult when it's time to buy a home, buy bigger purchases like a home, a vehicle, because what banks look at is your capacity to pay. So your debt to income ratio. Essentially what that is, and that's not on this slide, your debt to income ratio really speaks to the amount of debt that you have versus the income that you have coming in. So the simplest put, if you have a certain amount of income each month and that debt exceeds that, then your chances of getting a loan or mortgage or anything is slim to none. So you want to make sure that, you know, you're keeping that in mind when paying down your debt. That's another positive to paying the debt, owning different assets. Next slide. So again, as I mentioned before, we have several resources to help. We have here at Truist, we have what's called Money and Mindset that includes calculators and tools. There's financial personality quizzes. You can join Money and Mindset. There's a podcast that we have for that, bi-weekly email programs, and we will somehow get this slide out so that everyone has access to Money and Mindset. Next slide. There are also external resources. So USA.gov/coronavirus is a great program. CDC.gov is another program. And then there's a couple of relief programs through the Small Business Administration as well. There's something that's added, another added resource that we use here at Truist, which is Operation Hope. Operation Hope works specifically with consumers to help improve and educate around credit. So if there is a challenge on your credit report, they will work with you. They have counselors assigned, and this is not a company where you're paying to fix your credit. They are working with you to repair your credit or to establish credit through educated counselors that walk with you from step A to Z after they look at the credit report, and they tell you what to do and things to do to repair your credit.
Is that national? Operation Hope?
That's a good question. I don't know. They're Philadelphia based. I don't know. Matt, would you happen to know if they're national, Operation Hope?
They are national.
Okay.
That's
Awesome.
great. That answers another question that we had about resources for credit repair that are nonprofit. And another local one is Clarify. I know they're pretty busy though.
Yes.
That's
Mhm.
that's an excellent tool. I'm sure people would really appreciate that. Was there a QR code that you had up? Oh,
Yep.
okay. Did we get to your last slide? Scenario, did we get through all of your slides?
Can you move to I believe that was the Q&A was the last slide.
Okay. Okay.
Mhm.
All right, great. And sorry to interrupt. I just there was someone asking about the credit sources, so I just wanted to emphasize that.
Mhm.
Okay, so thank you. We are right at 2, so I think we're good to move into questions, right?
Mhm.
Okay, so before
Great.
that, I just want to thank you both for delivering the presentation. We do have a bunch of questions, but thank you for delivering the presentation so far. And if anybody has to head out, maybe this is a lunch break thing, I wanted to post to give our presenters time to post any information in the chat if they wanted to. I'm gonna put in our SBDC resource doc into the chat, and I'm also going to put in a survey for today's program. We are required by our funders at the SBA, the Small Business Administration, to collect surveys for all of our training programs. So I'm going to grab that link and pop it in the chat. I would appreciate it if before you hopped off for today, you completed that. We'll also send it in the follow-up. But in case anyone can't stay for the Q&A, I just wanted to make sure that you had that. And let me grab our resource page where we house information about our services, our webinars, including a library of recorded webinars, small business grants that are active. We keep that there on that page. So I'm going to put that in there. And then again, thank you both. I will thank you again, but thank you for the content. And then let's get into questions. Thank you for sharing your content information. That is excellent. Okay, so let's see. Should you pay, and I'm assuming this is credit cards, is there an advantage to paying your credit cards in full as it relates to credit as opposed to the minimum?
Okay, so that's a great question. So if you think about it, if you pay your credit card in full after you use it, then how are you establishing credit? So you want to kind of ask that to yourself. A lot of people choose, excuse me, a lot of consumers choose to pay it off. I typically see that with consumers that have credit scores over 800. If you have an 800 credit score, then by all means. But if you're in the process of reestablishing credit, establishing credit, then you do want to maintain a balance so that you can show a payment history.
Okay. Now going back, and you addressed this briefly, but if we wanted to get to it more, we had 2 questions. I think one was related to divorce and one is related to disability. So what if you were out of work for longer than 6 months and it impacted your credit? Any advice outside of go to work and get a credit card? I've been out of work for several years and can't return to work, the work environment that flared up their disability.
Luke, did you want to take that one?
Sure, yeah. So, there's that's a critical piece of information that, is included, in the reporting, and largely it's regulatory oversight so that those who have unfortunately been disadvantaged through no fault of their own aren't additionally, hurt or put at a disadvantage when trying to acquire credit. I know that a lot of private institutions are, there's many regulations in place that protects against any discrimination against individuals with disability or who, have even temporary, troublesome issues going on as it relates to, lapses in income due to a disability and so forth. So all that, there are mechanisms in place to compensate for anything in that regard. So
Yeah, and I'll add that it's Operation, what is it? Operation Hope could be a resource to reach out to. They may have some expertise there. And since you are on an SBDC webinar, I'm assuming that you're a small business owner, so that gives you the opportunity for a small business credit repair, credit building loan that some institutions, some CDFIs will have. I know the Community First does these, pardon me, these micro lending, like ROSCA type financing to help with credit repair, really small loans, and then building up from there is the concept about that. Okay, somebody is asking about consolidation of debt. So I guess how that might impact your credit score.
So debt consolidation is encouraged. So if you find yourself in a situation where you're maxed out on cards, or very close to being maxed out on cards, or just the inability to make even the monthly payment is tight, then a debt consolidation loan or consolidating debts on a credit card may be ideal. Because if you think about it, what you're doing is you're taking several small payments, consolidating into one. Chances are you're going to get a lower interest rate than you would off of the combined interest that you're paying on each individual credit card. So credit card rate, you may have one that's 30%, one that's 19%, one that's 18%. By consolidating that into one loan or line where you may have one fixed amount, that one interest rate that may be 15%, you're going to save yourself some money on your monthly payment. So, you know, if you're maxed out, then that is something that is encouraged.
Thank you. And would you say that the website that we posted earlier, annual credit, let me find that website, annualcreditreport.com, is that the best way to check credit score without damaging it? Someone asked that question.
Correct. That's the most efficient way. Yes.
Awesome. Yeah. So we posted that link in the chat, and I will do my best to remember to include that in our follow-up email. Okay. There's a question about outstanding student loan debt. Is it even possible to get that under control? Is it possible to try to start a small business to have a source of income to try to get that under control? And if someone can clarify, is that in terms of being able to pay down the debt, or what specifically did you mean by get it under control? If you're able to include that in the Q&A, that'd be helpful. But anything more general that you could respond to with that Luke or scenario?
So student loans is a very difficult one, which is hence their
pay down is the
yeah.
So having a small business to help pay down student loan debt.
So I can tell you that majority of my small business clients have student loan debt. They haven't paid it down. So when you're purchasing, for example, a mortgage or something like that, then they take an average of your student loan debt and they're not taking every single payment. They pick the average of your payments, and that's how they qualify you for the loan. I think a lot of that is because most creditors realize that most Americans have student loan debt, which I'm glad we're having a bigger conversation about today, and that it's very difficult for people to pay back student loan debt. With that being said, that will not stop a person from getting a business loan, a business line, or any other loan, because student loan debt is not viewed the same way that, say, credit cards and auto loans and mortgages are viewed, which is a good thing.
Yeah, so I think that's a really important point to emphasize, to be less scared of that, out of all your debt, to be less scared of that, just because of how creditors are going to view that. So I appreciate you pointing that out. And hopefully that answered your question. If not, feel free to clarify. Okay, we have two questions about APR. How is the percentage applied? And someone asked us the same question: how is it applied to credit cards?
Luke, did you want to take that? I'm sorry.
Sure. So, you have, ultimately, so my my expertise is in, in terms of talking about actual product types and the rates here at Truist. I can speak more so to business credit cards, individual personal cards. Maybe Scenario would be able to elaborate, but ultimately, the interest on any card is only going to be applicable after missing your window to pay any of the balance back. So theoretically, all that APR, which is a slippery slope, gets applied only after the period of time that you have to pay back, plus the grace period. I know a lot of our cards, it's 45 days worth of float. In the instance though, it is, credit card debt is like a really real compounding, quick to grow type of scary element, in the sense that, many banks and card companies, the interest associated with that is going to be up in the 20s, maybe low 20s. And if it's difficult enough to pay back a single credit card bill, it's going to be exponentially more difficult once interest gets applied. And then before you know it, you're now having to pay back that compounded interest amount plus what you owed from the previous month as your current month's payment is coming due. Credit card, in terms of like from, the retail banking community and personal debts, credit card debt is the scariest thing that gets out of hand, if you will, on a personal's credit report. So in terms of kind of the debts that can get nastiest the quickest, that's where a priority focus, I think, should be applied to attempt to avoid that. So.
Thank you. We have some questions from two different existing Truist customers, so we'll definitely pay attention to those. Someone is asking, I guess this is more of like a practical next step. How can I have a small credit line to build business credit for an existing business checking customer? So is this like go online? Is it go to your branch?
So you could reach out to myself or to Luke. The wonderful thing about Truist that is different from other institutions is that we look at the total relationship of the client. So we are not dinging someone specifically just for their credit. We look at the deposit history. We look at the total history, how long you've had a relationship. So as an existing client, we do encourage you to have a conversation with us about ways to help improve your business, whether it's for working capital purposes or if you need to purchase equipment or whatever the case might be. But to answer that question, you could reach out to myself. We've shared our contact information and we can tell you next steps, especially if you're an existing client, around applying for a line or a loan.
So relatedly, someone is asking, is it beneficial to have a personal checking account with Truist or another bank? This could be generally applicable before opening a business checking account.
Great question. So some institutions require, before they'll have any lending conversation with you, they require that you have a deposit relationship with that bank. We are not one of those institutions. I would say it does make sense from a convenience standpoint, because when you think about it, when you have your line or your loan due, it's very easy to just make a payment directly from your account. It's very easy if you need to access your line to be able to transfer those funds directly to your checking account online. So we try to encourage clients from a convenience standpoint to start the relationship. We also, again, we do look at the relationship when we're making our credit decisions. So while we don't require it, we do, strongly encourage it to start a relationship. And I think that's the case in any institution. So, when you think about opening, business line or business loan, for me, if I have enough trust in that organization, then I'm going to give them my relationship, my full relationship. I am going to have my credit card with them for my business account, my operating account, my merchant account, my payroll accounts. I would have that with the same organization. So hopefully that answered the question.
Yeah, that was great. Thank you. I think that I have gotten through most of the questions. I don't see more in the Q&A. Tried to get to most of the ones in the chat, but it's a little bit harder to navigate that. If I missed yours, if you wouldn't mind reposting that in the chat, then we can get to it right now. And I'll give everybody another minute to do that. And in the meantime, I'm going to repost our link to the survey for today's program again. Okay, I'm not seeing any more questions. I think we got to them, and there were many, and you were very thorough in responding, so I appreciate that. So I will thank everyone again for joining us. Please remember that the Temple Small Business Development Center is a resource for your small business, whether you are a client already. Oh, we do have one more question, so feel free to post that. But as I was saying, we have a lot of resources to support your small businesses. You can check out our calendar of events. The 15th of March is National Small SBDC Day, Small Business Development Center Day, and we are doing a very rare in-person mixer and pitch. Highly recommend signing up for that. You can never pitch your business too many times. It's just really to get feedback as opposed to a competitive setting. It's more of a friendly networking, be able to practice setting, and it'll be in person with refreshments. So definitely recommend people signing up for that. So we'll wait for that last question. And but if you need to head out for the day, thank you for joining us. Someone asked about credit cards from an insurance company. So yeah, I mean,
I see that question. I will read it out. It says, my insurance gives me credit cards with $10 to $25. Are these good to have? And what can I do if I no longer use after using funds? Also, is it okay to use travel cards?
Sure. So generally speaking, after you're done using a card, it's still going to be considered open and will appear as a credit facility on your reports. And if you have multiple credit facilities, then technically you could use it at any time, and it could max out your ability to pay back a potential debt that you're being, or a loan you're being evaluated for. So anything that's stagnant on your credit report, it will indefinitely appear there. You'll have to manually contact your insurance company to close that card, or you know, whatever, whoever administers a given card. And yes, it's fine to use, you know, travel cards, any card with any benefit justifiably makes sense. The behaviors associated with using the card are really the critical piece, and those behaviors fall on a good or bad spectrum in a universal way. So you want to, you know, continually, you know, use them responsibly and pay back on time, because each one is going to appear on your report.
So one point that you want to make with those credit cards, and this is again why it's important to get a copy of your credit report or use one of the services I mentioned to monitor credit, is, are they reporting? So, you know, you can have a credit card, but the key is it reporting to your credit? You know, whether it may not report to all three bureaus. Some creditors only report to one bureau each month, but the point is you want to make sure that this is a credit card that's reporting to your credit. And there's other services like Experian has Experian Boost, where you can add, you know, you can have other creditors added to help your credit card score and the credit card points. So you just want to find out essentially if that insurance card is reporting to your credit report.
I think that was our last question. Okay. Well, thank you, Luke. Thank you, Scenaria, and Matthew as well, the Truist team, for joining us today. We appreciate you, and especially your availability to chat with folks afterwards. with their business banking needs. So thanks again. Enjoy the rest of your day, everybody, and don't be a stranger. Hope to see you at another SBDC program soon.